And
great.
All right. Welcome, everyone, to our second session for Econ Camp. My name is Jeff Sanson. I'm the director of the Indiana Council for Economic Education. And presenting our second session is the U.S. Economy on Track for Recovery is Dr. Daria Sevastianova from the University of Southern Indiana. Dr. Sevastianova, take it away.
Thank you, Dave. And thanks to everyone for being here. The question about the economic recovery, of course, is a very complicated one. To begin to answer it, I would like to first paint with sort of broader brushstrokes, take a look at the overall economy, at some what we call fundamentals, and then focus on some of the specifics, particularly as they pertain to the labor markets. You can find St. Louis Fed information on their dashboard that goes over a lot of these variables in a very detailed, very informative manner. I will just look at some basics like GDP, employment, inflation, and consumer spending. But if you follow the link, there's no shortage of information on St. Louis Fed's website on how the economy has evolved since the onset of the pandemic in March 2020. So we will focus on the recovery statistics and a little bit more detail on the labor markets since the latest job report that came out in late September 2021 revealed some additional information. Some of it was surprising, some of it was not. So I just would like to explain some of the results that were obtained with the latest jobs report. And then to conclude and highlight some aspects of the recovery being uneven and also uncertain, even though it's certainly proceeding swiftly and is giving us reason for hope. So to compare and contrast where the US economy stood in spring 2020 versus now, fall 2021, remarkable progress has been made. First and foremost, if you look at the sheer unemployment numbers. In April 2020, at its peak, US unemployment reached 14.3%. So that question that everybody was asking when the pandemic began, whether it would reach the severity of the Great Depression, perhaps if you were to use the rate of unemployment as your basis for comparison, then the answer would be no, because of the height of the Great Depression, it was 25%, and here we just exceeded 14% in the recession pandemic. Today, it actually is 4.8, so below 5%. That is a very healthy number. That is a remarkably quick recovery if you don't focus on some of the details that are disguised in this overall statistic. So this is just the conventional measure that gives the percentage of job seekers out of the labor force. So the unemployment rate appears to have recovered back to the healthy territory. The decline in GDP in the second quarter of 2020 was quantified as 20%. And then today we're looking at 6.7%, so positive growth. There's a very revealing graph about this. So the production that was lost was made up for in the second half of 2020. That also is a positive surprise for the economists and the public. Seems to be a very rapid recovery after a very deep and short recession. Inflation is another variable that's important to compare. So it had barely achieved Fed's 2% target at the start of 2020, and today is quite a bit in excess of it at 5.4%. I believe this is using the so-called consumer price index, and certainly is the subject of many conversations and the focus of many concerns that inflation seems to have picked up. So we can talk about that in slightly more detail later as well. Consumption, particularly that of services, like in leisure, hospitality, travel, collapsed at the start of the pandemic, as did energy prices. Energy futures were actually trading negatively in March 2020, they too seem to have recovered. Some types of expenditures are up, especially those on services. The ones that were affected negatively at the start are now beginning to recover, as are energy prices. So that's a turnaround as well. The labor markets initially showed some losses, very unequal losses across regions and sectors. And what we're seeing today is that their recovery is also not proceeding at the same pace. So we can focus on some industries that are hiring more than others and compare wage growth in those industries or at those skill levels. So this is before and after, or at the start of the pandemic and where we are today. Some graphs as promised. The links to each one of these are interactive graphs from Fred, are available in every slide. So this looks at GDP growth, real GDP growth. Very good visual here. Shows the decline of our economy on an annualized basis, that 30% was lost, and then it was made up for later that year. And here where we are now is 6.7% growth rate, so pretty robust. Before the pandemic, 2% was the GDP growth rate, and unemployment was 3.5. Here's the unemployment rate, also spiking in April, but then falling from that high level and hopefully continuing to fall, although it certainly is not falling fast enough by some measures. This is inflation. The CPI is the measure here, both headline and core. So the red line will be core inflation that subtracts volatile components, food and energy prices. So that would be a lower estimate than headline, which is currently at 5.4%. So prices are recovering, but also not all prices are the same. We can look specifically at the categories of goods and services that are exhibiting price rises these days. So here actually the PCE is used. That is a Federal Reserve preferred measure of inflation. It's been used since 1959, has produced a lower estimate of inflation, on average 3.3% since the statistics started, versus 3.8 that CPI obtains. The advantage of using PCE is that it accounts for the substitution bias. So it looks at all household expenditures, whereas the CPI looks at how prices of goods and services within the so-called consumer basket that the average urban household buys change. And the substitution bias is one of the reasons that the CPI would overstate true inflation. It doesn't look at how people substitute away from relatively more expensive goods or those whose prices are going up towards cheaper ones. And also thanks to shopping at places like Walmart and Amazon, so not necessarily individual goods, but also retail venues. So the PCE is on this graph, as well as durables, non-durables, and services. So the one story that's very obvious here is that spending on services collapsed. That again was the affected sector of the economy at the start of the pandemic, but has since recovered and is projected to remain strong. So hopefully as people regain confidence and the virus subsides, that we can enjoy travel again and personal services again and go out to restaurants and buy airplane tickets. So that will remain in the positive territory. This shows percentage changes. With durables, the increase in spending on durables at the start of the pandemic is very much explained by the fact that people were buying home furnishings, equipping their offices and gyms at home as a safety measure when they couldn't go out. And so the projection for 2022 for durables, note this dark blue bar is actually in the negative, the way we think about this is, there are only so many desks and Pelotons that we need to buy, or homes or cars for that matter. So once the spending on durables is reached, it will subside. But hopefully we see services recover, non-durables continue to grow, and positive, of course, PCE projections here. All of this spending is fueled, with additional income as people come to work. Also, the fiscal stimulus that's been received, and some of it became savings. So we have about $2 trillion worth of extra savings in the economy right now, and that will be an influence here as well on what we see in terms of spending patterns. Maybe just out of curiosity, I pulled some numbers out that shows where the biggest price increases are occurring. Unsurprisingly, those used cars and trucks and rentals here have substantial numbers. Gasoline as well. Actually, oil and natural gas both are up quite a bit these days. Demand is increasing and supply is not. Laundry equipment, hotels, uncooked beefsteaks as well. So when we speak about inflation, it pertains to certain categories of goods, but it's certainly not consistent, not all across the board. And now on to the labor markets. So the report that's just come out shows that the labor markets are recovering. It's curious that we're down to below 5% unemployment rate just 17 months since the recession. For comparison, after the Great Recession, it took 6.5 years to reach the state of the job market. So probably safe to say that the recovery is proceeding at a rapid pace. Of course, this had everything to do with government support, but we are still seeing labor shortages today. Jobs are available, but people don't necessarily want to work. And this is affecting the shipping industry. This is causing supply chain clogs. We're seeing empty shelves, shortages of conductors that everybody knows about. That is causing underproduction of vehicles compared to demand for them. So these hopefully on balance will be worked out in time as these supply issues are resolved, and hopefully demand also goes down. And if you want to talk about inflation, it's easy to demonstrate just with a basic supply demand framework that a higher price level is achieved by lower supply and higher demand. So a rebalancing would then depend on increasing supply once these logistical issues are resolved, and hopefully decrease in demand. Right now, perhaps we're seeing pent-up demand with all the extra saving and the fact that people were unable to do certain things that now are coming back, like travel and dine out and stay at hotels and so on. In terms of unemployment, even though it's decreased substantially since the start of the pandemic, and yet again since August, when it exceeded 5% and now it's below, we're still talking about 5 million people who are unemployed compared to the pre-pandemic level. So that's a substantial segment of our working age population. So certainly the recovery of labor markets is not complete. The jobs report perhaps wasn't as rosy as expected. Economists were projecting 500,000 jobs added, but the actual numbers fell quite short of that forecast at 194,000. Unemployment dropped by about 710,000, and the number of working rose by 526, but still 5 million unemployed shows there is room for improvement. The interesting story here, when we ask why we're seeing these numbers, is that people are quitting their jobs and people are changing occupations. The pandemic, the way our lives were disrupted, provided the opportunity to reevaluate our personal and professional lives. And now many workers are reluctant to accept low-paying jobs or risky jobs or stressful jobs, and are seeking a better work-life balance and less stress and more time with family and meaningful employment. So this high number of quits actually signals confidence, that people are confident enough that they will find a better job, and that is why they're willing to quit their current job. Life is too short economy is what Betsy Stevenson calls it, but there was another economist that said what we have now is the take this job and shove it unemployment. That's equally catchy. So a recent study finds that 55% of our workers are now saying they will seek new employment in the next year. So expect a lot of churning. This is part of the so-called natural unemployment rate that we teach our students. Is comprised of frictional and structural unemployment. So a lot of friction as people quit and look for new jobs that hopefully will in time resolve itself. Well, this is a good thing, right? Workers have a stronger bargaining hand with unemployment insurance and payments. Here's 4 million people quitting jobs in July, very clear spike here. So quitting is good, it signals optimism, as opposed to being fired or laid off, right? We were all hearing about furloughs when the pandemic started. So this is good news. So our employment is growing, but unfortunately, labor force participation is falling. I would identify this as far as the labor markets are concerned as the second interesting story of this recovery. So the first one being is the take this job and shove it. I'm seeing some enthusiastic responses, that type of unemployment or quit rates. And secondly, the fact that labor force participation is falling is an interesting phenomenon that we're observing. So we have 3 million people that are currently out of the workforce. It was feared, what we would call a moral hazard, that such generous unemployment benefits and direct payments that were implemented by our government were reducing incentives for work, and that once those expired, people would get back to work. And we're actually not seeing that because the benefits expired in early September, and yet a lot of people are still not coming back to work. So that fear did not really pan out. People are waiting longer, looking for better jobs. They have all of this fiscal stimulus to hold them over. Now, of course, there's still health risks, so there's some reluctance. There are still women who do not have reliable childcare, so they're not yet ready to go back. There's, of course, been discouragement, and that's an explanation of people dropping out of the labor force as well. And retirements is another explanation why labor force is declining. So a lot of complementary reasons here for why we still have over 3 million out of the workforce. Overall, labor force participation now stands at 61.6%, which is about 2% below of what was the case at the start of the pandemic. Perhaps more interestingly still is the fact that there's a substantial gender disparity. So this average 61.6 disguises the difference between female and male labor force participation, where female labor force participation is 55.9% and male labor force participation is 67.7%. So that is a big gap by gender. I always love to show these graphs because truly the devil here is in the details. So overall, you can see here on the left, and then by gender on the right, men are the blue line and women are the red line. And you can always use this to give your students some historical perspective, that one of the fundamental facts of the US labor market is that after World War II, women join the workforce very steadily. You see how it steadily rises before it levels off in the year 2000. Men have done the opposite, right? So this is a very interesting story where you can talk about the influences in the labor force and how manufacturing jobs have been lost, and the civil rights movement and education of women and equal opportunities and so on. But what I want to focus on here is this gap here between where female and male labor force participation stand today. So we see that they both declined, and the distance is quite a bit. And this is where the story that women were on the front lines of the pandemic, being in those vulnerable service occupations, fits in. The fact that women went home to work from home and help their children learn from home and provide childcare or be caregivers for family members, for the elderly, for the sick. These are the roles that women had to take on. And to a large extent, not all of us are yet ready to rejoin the labor force. So yeah, the gender story here is interesting. Here's a chart that I found on the Bureau of Labor Statistics website. If you want to specifically talk about the changes in the US labor force throughout time, then, besides age, because this is the participants who are both those working and looking for a job, employed and unemployed, relative to the working age population. This is the equation here. Employed plus unemployed divided by the adult population. So when labor force shrinks, it's probably, a function of age, like you have retirees, so you have fewer people that fall within that group that could influence this ratio, but also disability or being institutionalized, discouraged, or marginally attached. This flow chart summarizes the reasons why the labor force could be declining. There's a cyclical component to it too. As jobs are lost in recessions, we see that labor force declines. Also in recessions, we see that more people stay in school or go to graduate school under influence because the job market isn't good. So usually a very rich discussion with your students, and one that now could also be supplemented with how women have been affected. There's an interesting word to describe this recession is a she-cession, a reference to the fact that women really had to bear the brunt of the pandemic recession. So for those who do want to work, the labor market is good news these days. I actually received an Amazon flyer myself the other day that said sign-on bonus $1,000 on it. Pretty impressive. I've heard of greater amounts too, actually, offered by local employers. So as tough as our college students have had it in the pandemic, those who have figured it out and managed to complete their degrees or are close to completion, they're actually entering a very promising, strong job market right now. Companies are hiring again, they're recruiting again. We just hosted a career fair. It was very well attended, both by employers and our graduates. Not a bad time to be coming out with a college degree. It has a premium these days. And if you can get the sign-on bonus, even better. And there's wage growth, particularly in service occupations these days. Well, we actually see if we can compare by low, medium, or high wage. Of course, that links to types of occupations. We will see that it, in fact, is the lower wage earners that now can benefit from fastest wage growth. So 4.9% versus high wage, which is at 2.7% currently. Overall, on average, about 9.5 is the rate of wage growth. So why are wages rising, or what does this mean, is another interesting question to contemplate in the classroom today as we discuss the economic recovery. One thing to point out is that real wages, nominal wage divided by inflation. And so if nominal wages are growing at 9.5% and inflation stands at 5.4 using the CPI, well, then on real terms, it's actually not as impressive, or is in part offset. The rising wages is offset in part by rising inflation. It could also be that the increases now that are hurting employers will have to be passed on to consumers through higher prices. So if in fact rising wages are feeding through to inflation, that is maybe how an inflationary spiral starts. That also is a rich topic in economics. And of course, it's productive to think about the reasons why wages could be rising on a pure theoretical basis. It could be a quantitative explanation, like a larger share of labor in production, or a qualitative explanation. If productivity rises, wages rise. Well, and productivity, in turn, you can explain, depends on things like technological innovation and human capital. And so this would be the most sustainable way to invest into future wage growth, into our labor force, is by investing into productivity. So this is where spending on research and development, including climate change, on technological innovation, on healthcare, on education, like free community college, these would be productive investments into future productivity of the workforce that would increase wages and quality of life. So as far as sources of growth are concerned, they also could be brought into this discussion of rising wages. Here's the graph I was talking about. Atlanta Fed published this. I thought this was really interesting. Maybe you could relabel it in a little more straightforward manner, like putting a label by this green line here. It's called first quartile, meaning the lowest 25% of wage earners. Here's your service occupations, leisure, hospitality, travel, experiencing the fastest wage growth compared to the other quartiles. So 25 to 50%. The next quartile would be the second quartile, this orange line, and then this burgundy, 50 to 75, and then the blue is the lighter blue, fourth quartile, 75 to 100. So this is the high wage workers here. You see actually experienced a wage decline, even though through the pandemic, they've not affected much, but are exhibiting the trend opposite to that of the low wage earners. These two lines are diverging. The overall here is the darker blue that's kind of disguised by the other colors. But this is interesting, or maybe not, is the service sector that was most heavily affected is recovering the fastest, and that's where wages are rising. Employers are trying to entice workers back to restaurants and hotels with these higher wages, but they don't necessarily want to come back to those jobs because life is too short economy. This all kind of fits together as pieces of the recovery puzzle. And the labor market is the interesting human story I feel many of our students are curious about because they are the future workforce. They are thinking about their future occupations, about their college education. And so it's interesting for them when we talk about careers of the future, or what jobs pay or are secure from automation. We can address these topics from the pandemic context, because technological innovation is a big piece here as well. I'll come back to that in a second. So a little bit about how the burst in GDP growth is now and the hiring that we're seeing bring inflation. So the CPI, as I already mentioned, stands at 5.4%. compared to 12 months prior. So there are different but complementary explanations. I feel it's always productive to cast this through the framework of supply and demand. So shorter supply, shortage of resources, some raw materials, but also workers who are in tight supply, or worker shortages is one influence. Our demand also is higher still as we make up for lost consumer spending in 2020, particularly empowered with the fiscal stimulus and the 2 trillion extra savings now available for the savings. In addition to this, wealth increases when the stock and the real estate markets are doing well. So any of us with those assets in their portfolios, when they gain value, become wealthier. So that's another thing here. Households are in stronger financial position. We're seeing household debt going down, lower foreclosures and personal bankruptcies, thanks to all those forbearance programs that were part of the fiscal stimulus. Wages are rising. That's another possible channel to higher inflation that we're seeing today. And of course, energy prices affected as well. If you want to go there, of course, monetary stimulus, ample money supply, low rates, yet another reason here. So monetary policy would be also an influence on what the price level is doing. So lots to talk about when connecting the labor market and inflation. Some good news in some. So we're seeing lower unemployment, stronger growth once again. Consumer confidence is up significantly. This is the first recession. Consumers are in a stronger financial position after it ended. Fewer delinquencies and foreclosures and bankruptcies, like I already mentioned. On the basis of race, Black and white unemployment gap we see is narrowing, so that's also good news. Of course, Black unemployment stood at its lowest percentage before the pandemic, so that too is an outstanding issue. We see that workers have adjusted to remote and hybrid work. We had to accelerate years forward within the span of a couple of weeks, change our work habits when the pandemic started, very much reliant on technology. So firms are investing and continuing in that venue. They're now reconsidering how we work. Over half of workers are now saying they would like to work from home 3 days a week. That's what the recent polls indicate. And employers now are hearing this message. They're not quite there with 3 days a week, but at least 40% is what the last Gallup survey indicates. 40% of work to be done from home is what employers would be agreeable to. So work and life, of course, is being redefined, and technology is playing a major role in this. Another piece of good news is that hunger is down. This was the Census Bureau statistic, 30% in 2020. And thanks to child payments, child poverty has also declined. So this has generated momentum for child payments that are now part of the new Biden plan, since we've been able to see what a difference they make. Would it not be better to continue with these child payments so as to create a more equitable future society? Poor children go on to be poor adults. And so to lift children out of poverty, out of hunger, provide them with childcare and good education is very much an investment into our future workforce and solving our issues of poverty and income inequality going forward. So from the policy perspective, today is a very productive time to contemplate the investments we want to make into the future of our economy, our society. With the right decisions, of course, they're expensive. Of course, we're talking trillions of dollars worth of stimulus, worth of policies, but we could potentially come out stronger. We all hear that the pandemic has accelerated some trends that existed before it. but it also provided opportunities for future improvement. And so I actually want to be very optimistic that we can emerge as a stronger society in the pandemic's aftermath. It's not all good news. Of course, there's still quite a bit of uncertainty. The Delta Plus variant, I hear, is on the way. The rate of vaccinations has slowed, so nobody knows when the pandemic will actually be over. The adjustments continue in how we work, how we live, how we spend. So we just have to stay on top of this changing economy, on top of this recovery. There's a fabulous website, tracktherecovery.org, and there's no shortage of information depending on the aspect of the recovery that's interesting to you. It's good to stay on top of these statistics and see what story emerges. Again, I want to be optimistic that women in the end will fare better, that they will have more flexible work hours, that we'll be able to work from home more, spend more time with children, that we will have accessible and affordable childcare and child payments. Most Western countries have those, and they make a big difference. Ours, of course, are tied to employment. Ours are tax credits, not just payments without any contingencies, but still would be a step in the right direction from the standpoint of the quality of women's life and how employers are willing to consider women's needs in the workplace. I think this is fair to consider, especially if we want to get women out in the workforce in greater numbers. It's important to consider the work-life balance that women face. We have a lot to contribute. Potentially children can fare better, again, with school lunch programs. My daughter has subsidized lunch at her school for the second year in a row. I think that's fantastic. I still pack her lunch. She eats both, the lunch that I pack and the lunch at the cafeteria. She's grown 4 inches. It's wonderful. And of course, investing in children's education is a step in the right direction. Yeah, with technological innovation, the way the pandemic has accelerated, a lot of these changes were already obvious before the pandemic. How we went to virtual meetings. So teleworking and online shopping and streaming, they all existed before. But now these are very broad forces where it's difficult to think actually about going back before the pandemic. We're used to deliveries now and doing so many things virtually. Virtual medicine is another interesting development that will stick. It's very convenient. It doesn't expose you to the health risk from going to the hospital. So we potentially stand to gain from these adjustments. In the words of Jerome Powell, we're not going back to the pre-pandemic economy. That's how he addressed a college audience recently, talking about whether there would be a going back to normal. Some of it is bad news, but some of it is good news. As I mentioned, with the right policies, we can come out stronger. So yeah, just to wrap up, I know I'm throwing a lot of information at you guys. There's different themes here, different statistics to ponder. All in all, the pandemic was severe, the recession was severe, but short-lived. The fiscal stimulus and monetary, as Dave will explain to you later, both had a prominent role to play in supporting households and businesses, also our state and local governments. So we have benefited from this very generous package of policies here in the US. The recovery is by no means complete, particularly if we look at the labor markets, where 5 million people are still unemployed compared to the pre-pandemic unemployment level. They're looking for better jobs. Labor force participation is down by 3 million. That's a big challenge for us, especially as we incentivize women to come back to the workforce. So some improvements would be very desirable, not everything is bad news when we come out of the pandemic. But most self-servingly, I will point out that this crisis is a great time to teach economics. I feel like I always say this. I said this during the Great Recession, during the dot-com bubble. This is where people want to understand the economy. They care about what's going on with inflation or energy prices or the job market. Students want to learn economics. So it's a very interesting time. Our discipline is always interesting and always useful, but with the ever-changing economy today, it's that much more inspiring and that much more interesting to interact with students about all of these concepts. Talk to them about the changing policy environment. If you can compare the domestic and the international economy, there are some very interesting stories there as well. You can discuss how Europe guaranteed workers' wages and how they fared compared to our unemployment benefits and the stimulus checks in the US. Talk to them about the labor market. Talk about technological innovation and the future of jobs. The pandemic is an interesting lens to the economy, and this is the content that everybody can benefit from today. Thank you, guys. I will open it up to questions at this point. And I apologize about the sun being in my window like this. I considered standing up, but no disruptions.
No worries. I'm going to just make a thank you for both of the session 1 and session 2 presentations. It's always good to get a little bit of insight and see where the data is leading us. And, you know, we kind of talked about when we were talking about the session back in the spring, you know, would we be, we think we're going to be in a recovery, will we be in a recovery? And so, you know, I think it was timeliness to kind of take a look at some of those trends. And I appreciate your insights today. So, I will give people online here a chance to ask some questions, but I just want to say to the people watching this on demand, if you have questions, you can go to the form that's linked in the email and send them, and those will be answered in the order. So thanks to everyone for watching. I'm going to